So welcome again. We have seen what are shares. This is just a beginner series. So today let's see how shares work at NSE. This is for Nairobi Securities Exchange. My name is Peter Chege. That's my WhatsApp number, just in case you have any query you'd want to reach out. So how are the shares created? We said when you own shares, you're owning part of the company. So when you buy shares, you're not just buying the numbers on screen, the numbers you see scrolling. You are buying a little piece of that company. If you buy shares in Safaricom, you're actually becoming a part owner. So then, how does it work in real life? Let's take an example. Cocoa World. Your friend owns a small shop, which they decide to call Cocoa World. This shop does well, but they still want to expand and open as many branches as they can. So to raise money, they decide now to sell the small pieces of that company. So each piece of that company is what is called share. So what's the process? One of them is through private placement. You come to that. The other way is where now the company decides to join the public. That is through Nairobi Securities Exchange, NSE. So this company have grown enough and it wants to join NSE. NSE, you come to see what it is. It's a marketplace where companies sell shares, and you as the investor, you come and buy. So the existing investors sell shares. You want to buy, you just come in. And the reason they would be selling is that they want their money back. So a company divides now this shop into 1 million shares and sell them to anyone who wants to be part of that company. So what do they do? The first time that company comes to NSE is called initial public offer, that is IPO. If they are listing through IPO, we'll see other ways of listing. So this is where the people who want to become part of now the company, they buy shares, they apply to become shareholders. Let's say a company says for every one share, you're selling five Kenya shillings. So it will depend on the amount each person have. So they will divide with 5 and now apply for those shares. If there is no oversubscription, they get full shares. If there is oversubscription, then the company takes up to the maximum they can. The rest is refunded. So at that point, now the new buyers become part of the shareholders, and the company now gets money to grow. A good example, Safaricom in 2008. Kenya government decided to sell part of it to the public, and they decided for each share we are giving it 5 Kenya shillings, and people bought. So the way it worked, you'd go to a broker, open a CDS account, apply. Then once you are allotted, shares are loaded to a CDS account, and money is sent now to Safaricom to do whatever they were listing. If it was government to get back part of that money, then they get the money and did the investment they wanted to do. So they sold part of their shareholding. So those who bought early, they have seen value through dividends and also growth in terms of prices for those who have sold. For those who have not sold, they have seen fluctuation in profit. We call them paper profit. Where yes, the prices move up and down, but you don't realize them because you don't sell. So only when you sell, that is the time now you realize the actual profit. So there are those who have seen Safaricom go up to 40, go back to 20s. Like now it is 20s. So they have lost that opportunity. The 20 shillings, it has gone down with about 19, between 10 and 20 shillings. And there are reasons why prices keep on moving. We'll come and see. So that's how ordinary Kenyans became part of now Safaricom. Safaricom is owned by 3 types of investors. There is the government, which owns 45%. Then there is Vodacom that owns Safaricom is owned by three entities: government, Vodafone, and also you as the public. So the public owns 25%, government owns 35%. So that comes to, if you do quick mathematics, is around 60. Then 40% is owned by Vodacom. Vodacom is also owned now by, sorry, Vodafone is owned now by Vodacom, um, and also Vodacom Kenya. So that's a shareholding of the Safaricom. Kenya government, Vodacom through Vodafone, and then there is you as the public. So after the IPO, the company now lists. So new shareholders have come in, they've given money to the Kenya government or to the company, and they become part of the shareholders. These people who have already given money to the company wants to get out. They do it now at Nairobi Securities Exchange, the market. So that's where now trading starts to happen. You want to sell your shares, there's somebody who want to buy them. So demand and supply now controls the market and the prices. So you buy now, say, cocoa out shares. You bought at 5. Now they are being sold at 10. You buy. So the person who applied through IPO 5, they have gained 5 Kenya shillings per share. Then somebody else wants those shares, maybe that price have gone to 15. You as the person who bought from the market at 10, you want again to sell at 15. So as the price appreciates, each shareholder who buys sells at a profit. This buying and selling, it's called secondary market. So primary is when the company is getting in through IPO, if they're getting through IPO. Secondary trading is when now you as the investors start to buy amongst yourselves. You make profit or you make losses depending on how prices are. Then the other way companies also get to NSE is listing by introduction. So what is listing by introduction? A company joins NSE without selling new shares or without raising money. So they are not getting money from the investors. They are only allowing the existing investors to trade their shares in stock market. That is, there is somebody who bought shares over the counter or through private placement, and they want to get out. So this company listed NSE to give them an easy way of getting out. So they sell to the public. Then the person who buys becomes the new shareholder without company returning money back to them. So why then would a company do this? A company doesn't need cash that moment. And they already have many shareholders who may want to exit. And instead of continuing to do it through OTC, which is a complicated process, they want an easier digitized way. They also want visibility and share liquidity. Share liquidity is where it is easy to get in and out. You can buy and sell easily. Remember, in OTC, you have to look for a buyer and also a seller. It's also cheaper and faster than IPO because a company just opens on one day and the shares are just loaded at NSE without any complicated process. The way it works, company decides to list, they prepare the necessary documents, get board approval, CMA and NSE approval. Once that is done, shares are moved to CDSE. So for trading to happen, shares have to be loaded in CDSE account for the existing shareholders. If they don't have CDSE account, they are opened quickly and the shares are loaded. Then after that, those shares are admitted at NSE. This is called the listing. Yeah? They are loaded at the NSE trading system, and that is pushed to the broker platform. From there, now you can start trading. Yeah? No new funds are raised. It's only the shares that are existing that are traded. So no new shares are created. If they have to create them, they have to do private placement before listing. Yeah? Like what have happened with Family Bank. A good example, still our Loose Cocoa World, a successful company in Kenya. It has, let's say, 10 plus founders and early investors, those who bought shares through uh, their offices, then they have enough loyal customers and they are making strong profits, but doesn't need money right now because they are making profit and they don't need to expand. But these early investors want to exit. So they choose to list by introduction. So they want this brand to be trusted worldwide. Immediately you list an NSE, remember now you are visible even to the world through the trading platforms. And analysts pick that company, start to do analysis. So you get that exposure. Also, early investors want their money back. So they sell those shares to new investors. Also, you as a public, you want to get in. So that's where now trading comes in, buy and sell. They also want public visibility without taking any loans or raising capital. They don't want to do IPOs or even float a board. So the listing will help now attract new partners, even institutional and foreigners, depending on how the company performs. And as usual, you make money now through various ways as the investor, not the company. You make money from shares mainly two ways. One of them is dividend. A company makes profit, they decide to share that profit with you. So you are not selling shares, you are just receiving free money equivalent to your shares. I might say for every one share, you are getting one Kenya shilling. So you multiply that by the number of shares, then you rest withholding tax, depending on your account type at CDS. Then price growth, and this is confused with uh, growth stocks. Price growth is where your share prices rise and you sell for more. Growth stocks, people confuse this with the usual theory in school, where you're told you invest in a company, it grows, you grow. When a company grows, you don't grow if price is not growing or that company is not giving dividend. I'll come to this into details. In a real market, theory doesn't work. The theory from school doesn't work. When we say growth stocks, what it means, your price move, the price you bought at have a potential of increasing. That is a simple thing. It's not a company really growing. Even if the company grows in size, it may not grow in price. Look a good example. Safaricom prices, they keep on fluctuating. While the future holds, these are companies that can be affected very easily by politics and prices crash down. Look at some of the companies that have gone under. Mumias. And there is also Uchumi, which is currently one of the trading stocks, which I highly discourage people from buying. Those companies in 2007, 2008, 2009, they had very good potential. And by that time, you'd say this is a growth stock. But where is it right now? People who bought that time maybe above 10 shillings. The companies, some of the Mumias have already been suspended below zero point 0.5 shilling. Uchumi is just because of speculation, prices have adjusted upward. But it's a company that is headed to suspension if it doesn't perform. What does that tell you? Growth stocks does not mean company growing. Growth stocks are companies which have potential of growing your valuation in terms of price and also dividend reinvestment. So dividend stocks are stocks that give you dividend. Growth stocks are those that appreciate in price and grow your portfolio. So in theory, it's the other way. In practice, it's the other way. Now I hope you understand. Growth stocks means growth in your portfolio in terms of profits, price going up. That you need to be aware. When you buy shares, you're not giving money to the company to grow. No, 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 no. This company was given money when investors came in the first time. What you're just buying in the market, you are buying out an existing shareholder. You give them money, they give you shares. If those shares don't grow, your portfolio is not growing. So for growth stocks, our companies have a future that can lead to growth of price, making your portfolio grow in valuation. That is the simplest explanation of growth stocks. We'll come to all these in details. Then why people sell shares instead of asking company to refund. Remember, you give money to this company. They have already invested. You can't go back and ask for your money. So when you buy shares for the first time, your money helps the company grow. And this is not a rule. No? They have given you shares in return. No? You become an owner. You're not trading. Trading is when a company floats a corporate board. No? So if you ever want your money back, you don't go to the company. They've already invested. That's why they listed NSE so that another person can come and buy you out, give you money, you exchange with shares. Huh? That is the simplest way you can exit your investment. So when you buy shares, you are part of that company. You become a history in that company, a story. If that company grows and price appreciates, your portfolio grows. If that company grows and price stagnates, you don't grow. If that company grows in profit and they decide to share, you get dividend. If the company grows and they don't give dividend, you don't grow. So growth stocks are those stocks that grow your portfolio in terms of valuations. And dividend stocks are also growth stocks. Ideally in NSE, growth stocks and dividend stocks have no difference apart from the big players that have high prices that don't fluctuate a lot. The stable stocks, those are purely dividend. There are those that move in price and give dividend. Those are growth stocks and also dividend stocks. Penny stocks, however, are not dividend or growth stocks. Why? Those are speculative. Those are shares trading below 10 shillings and which price moves because of speculation, not company performance at all. So when you become a story of this company, you receive dividends. That is a profit share. You also watch your shares grow in value. Those are the growth stocks. And as I have said before, you always have rights to attend AGMs, but they don't have financial gains. So if you buy a share that is not giving you dividend and growing in price, then the best thing that share is helping you is to attend AGMs, which doesn't help you. So in short, shares is just a little piece of a company you can buy, sell, and earn from. That's how shares work in a very simple layman language. So we come to the other advanced topics. We first see who are the major players, how they work, and now how you buy shares, how you open CDSE account, and how you grow your wealth. Remember, you're in NSE to grow wealth, not to pack money. In NSE, it's not like money market. You have to actively trade to make money. If you're looking for dividend, you have to keep on buying and grow your portfolio to grow your dividend. If you're looking for price growth again, you have to keep on watching prices and grow your portfolio. So for detailed tutorials and notes, they will be available on my blog. The link is in the description and also on the bio. Also, you can join the WhatsApp community where I am now keep on training and also Telegram. And I'm now on our social media, YouTube, TikTok, Facebook, groups and pages, Discord channel, X, Instagram, LinkedIn, and soon coming to Udemy for those who may want professional training, especially those certifications for Udemy. The link is in the bio and also in the description of this video. Let's meet in the next one. Thank you. And remember to subscribe and follow for more.